Imagine colonial India in the 19th century. The government faced a deadly cobra problem and came up with a clever solution. Pay a bounty for every dead cobra brought in. Sounds straightforward, right? But instead of fewer cobras, people started breeding cobras just to kill them and collect the bounty. The cobra population exploded from a few thousands to tens of thousands in just a couple of years. This bizarre unintended consequence is called the Cobra Effect, a classic example of a perverse incentive. A perverse incentive is when a policy or payment scheme unintentionally motivates people to do the exact opposite of what was intended. And it's not just an odd historical quirk. These perverse incentives run rampant in modern finance, hiding in banks, investment fees, government bailouts, credit cards, and insurance. In this episode of Unfiltered Money, let's unpack how these incentive traps work, why they matter, and how they impact your money. Most banks and asset managers charge fees based on assets under management or AUM. That means the bigger your portfolio, the bigger their paycheck. On average, global mutual funds charge around 1% of AUM annually, while active managers often charge as much as 2%. For every 1 million you invest, that's $10,000 to $20,000 a year, no matter if your investments go up or down. Here's the kicker. Those fees compound over time. Even a seemingly small 1% annual fee can slash your long-term returns by more than 20% over 30 years. That means the wealthier you get, the more your asset managers earn, often for virtually no additional work. Imagine your portfolio grows from $1 million to $5 million. That 1% fee jumps from $10,000 a year to $50,000 a year, and managers get paid on that entire amount regardless of whether you earn a dime in profits. This creates a perverse incentive. Managers may focus more on attracting new capital and growing asset size rather than actually growing your returns. Studies have shown that the average actively managed equity fund underperforms its benchmark by about 1 to 2% annually after fees, meaning investors often pay high fees for mediocre or worse results. Hedge funds and private equity often claim to solve this misalignment by aligning interests with investors. You have heard of the 2 and 20 fee model, a 2% management fee plus 20% of the profits. The idea, you pay big fees only if your money grows. But here's the reality. Hedge funds still collect that 2% management fee no matter what. In 2022 alone, the global hedge fund industry collected approximately $60 billion in management fees alone. Even more striking, hedge funds typically take home about 75% of all the profits they generate after fees. So out of every $100 earned, investors only keep about $25. And despite this, academic studies show no persistent performance in hedge funds. Funds that do well one year rarely outperform again the next. In fact, about 80% of hedge funds fail to beat the market after fees over a 5-year period. This is another example of principal-agent problem, where the agent, the manager, has incentives that don't perfectly align with the principal, the investor. Managers are motivated to chase high-risk, short-term returns that generate big fees rather than steady, long-term growth that benefits investors. The dangers of this misalignment were visible in the collapse of long-term capital management in 1998. This hedge fund used leverage of 25 times their capital to place massive bets. When Russia defaulted on its debt, LTCM nearly triggered a global financial crisis, all while managers made millions during good years. The principal agent problem means investors need to be extra cautious. Fee structure should incentivize managers to deliver real value over the long haul, not just chase flashy returns. Now let's zoom out to banking and government bailouts, perhaps the most famous example of moral hazard. Moral hazard means when protection from consequences encourages reckless behavior. If banks think government will rescue them when trouble hits, why play it safe? In the 2008 global financial crisis, the US government launched the Troubled Asset Relief Program, the TARP, with an initial fund of $700 billion. Contrary to popular belief, TARP wasn't a free bailout. It was mostly structured as a loan or preferred stock purchases requiring repayment with interest and dividends. By 2014, the US Treasury had recovered approximately $441 billion from TARP investments, making a profit of around $15 billion for taxpayers. So while the headline claimed banks bailed out with your money sticks, the reality is more nuanced. Still, public frustration remains because bailouts create a systemic moral hazard. Banks may continue risky behavior knowing losses could be socialized while profits remain privatized. This means the underlying problem of excessive risk taking isn't fully solved, it's postponed. But moral hazard isn't just about banking. It's especially dangerous in insurance. Insurance is designed to protect people from risk, but if payouts come regardless, it can encourage carelessness or even worse. According to the Coalition Against Insurance Fraud costs the global economy over $80 billion annually. roughly 10% of all property casualty insurance claims. And while rare, extreme cases of insurance homicide where people deliberately cause harm to collect payouts have been documented worldwide. This is the darkest form of perverse incentives, where financial reward stems unethical, even criminal behavior. Even in everyday insurance, studies show that people take more risks or delay repairs when covered by insurance because the cost feels cushioned. Let's talk about a more familiar example: credit cards. Every time you swipe your card, merchants pay an interchange fee, typically 1% to 3% of the transaction value to the bank and to the card networks. Merchants often pass these fees on to all the customers through higher prices, causing a hidden form of inflation. A 2019 Federal Reserve study estimates that interchange fees cost the average US household about $200 a year, baked into the prices they pay everywhere. Banks want you to carry a revolver balance, meaning you don't pay off your card fully each month and rack up interest, which can be as high as 20% to 30% annually on outstanding balances. But banks don't want too many non-performing assets, loans that go bad, because regulators require them to hold extra capital against risky loans. These capital requirements can range from 8 to 12% of RWAs, meaning banks have to keep significant reserves for every dollar of risky loans. So banks carefully balance encouraging profitable revolving debt while minimizing defaults that eat into their capital and profits. Why do these perverse incentives persist? Because perfectly aligning interests between managers, banks, government, and customers is incredibly complex. But there are ways to improve: refundable fees when managers underperform, clawback of bonuses for bad behavior, and longer-term performance measurement help align incentives better. Japan's government pension investment fund revamped its fee model to tie fees more closely to longer-term returns rather than just asset size. Some hedge funds use high watermarks so they only earn performance fees on new profits, reducing the chance of charging fees twice on the same gains. At its core, the Cobra Effect warns us to watch out for unintended consequences, whether it's banks charging fees on portfolio size rather than returns, hedge funds chasing risky capital gains, credit cards quietly driving inflation, government bailouts encouraging moral hazard, or insurance tempting fraud. Charlie Munger once said, "Show me the incentive and I'll show you the outcome." Understanding these hidden forces help us push for smarter, fairer financial systems, ones that reward good behavior and protect consumers. If you enjoyed this deep dive into how incentives shape finance and risk, hit subscribe and check out our channel Unfiltered Money. Thank you for watching.